All right. Well, welcome everybody. Keep the cottage, fund the future. This is what we're all about. What we're talking about today is really, you said Dan's got a long history, his family cottage. We're going to go through a bit of that as well too. But, at the end of the day, Dan and I are life insurance advisors. Our biggest piece is we're going to help families on the funding piece of it. But when it comes down to any of these types of solutions, it's about like building a team around you. And that's part of what we do is that we're really focused on building the right um, team. One of it is one of the folks that we work with closely is Subhastin. He's a director of sales and insurance, director of insurance sales at Equitable. He's really great at collaborating as well. You said we are life insurance advisors. You're going to see we're gonna put in other content as well that's really going to like talk about some of the other important steps with the important people as part of the process too. And so let's get rolling here. um, you know, we're going to do more of a formal introduction to each of us in terms of what we do, where we come from, our cottage stories, some of the goals, and why we're doing this. And then we're going to dive into the problems. What are truly the problems? I think the hard part with any of these things is just like it's just getting started, right? And I think a lot of us really know the problems, so we're going to try to highlight them, create conversation. Hopefully what you take from today are things that you can take back to your family to start that discussion. Maybe it's been things that you kind of danced around a bit, but like sometimes those hard conversations have to be had. And you know we'll dive into that more. We'll talk through some of the solutions, how that can work. There is some flexibility and options, and maybe you'll learn something today that you haven't heard before. So we're hoping to get there and help you protect your cottage legacy. I think that's the essence of why we're all here. And then we're going to wrap up and talk about how you can connect with us to learn more. All right, Dan, over to you.
Yeah, we're really excited to be down at the Fall Cottage Life Show at the International Center November 15th, 16th, and 17th. So if you're down there, please drop by, say hello. I'm really excited to have conversations. We will be doing a free ticket draw tonight at the end of the webinar. So there will be some lucky winners tonight. So stay tuned on that. So what is special about the cottage? What is not special about the cottage? You can see here the different things that we have highlighted. We have family. Family is so important. This is actually the first one. This is me with my family, my three beautiful kids, with my wife, and just campfires, being beside the lake, quality time, watching kids grow up, chasing frogs, fishing, etc. Friends, we always really enjoy having friends up, breaking bread with old friends, new friends, reconnecting, and making memories. There's something about the water at cottage. There's something about the draw to that. It just, whether it's the waves, or whether it's those calm mornings, or the mist, or whatever, the cottage is and the water is super special in terms of the cottage. And then just being in nature, you can see the loons calling, just feeling right, disconnecting from the cell phones, from the computers, and just relaxing is certainly the essence when it comes to what is special about the cottage. Next slide there, Pete.
All right, so maybe I'll just start with a little intro on myself. It's a picture of myself and Dan here. Obviously, I'm married. I've got a son and daughter. Actually, I got to update the slide because they just had their birthday this month. So, son's now 13, my daughter's 15. We're very deep into hockey season right now. Coach, actually, just coaching my son's team this year. And then we're during the off season, we like to travel, enjoy hikes, all that kind of stuff. We're big foodies as well. The really why I got into this business in the first place is just really when I understood what we do and what life insurance can do for families, it creates amazing impact in terms of families um, creating impact down the road, but also if you understand it well, it can actually impact you now as well too. So that's my big theme. Dan, over to you.
Yeah, Dan McMullen, married with three children, son's 11, 8, daughter 5. really it comes down to me. This hits home really strong. I have a cottage on Lake Kashrigmog. It's been in the family for generations. I really enjoy fishing, hiking, all things sports. And I really am passionate about helping families, helping keeping these cottages in the families for generations to come. So it really hits the core.
And with us, we have Subhastin Kharag. Sebastian, are you able to maybe add a couple words to yourself? For me, if you like, I'll start it, but then maybe you can add into it. But I've known Sebastian pretty much as long as I've been in the industry. I haven't been in as quite as long as him, about half a decade myself. But Sebastian's been amazing. He's a great collaborator in the point of where we talk about this is, like in every work, all the work that we do, we're always involving different professionals and even other advisors too, to make sure that we get the right support for our clients. Sebastian really speaks to that. And to cottage stories, mine's pretty quick actually. Mine's kind of like, you know, mine's one of the results that could happen out of this, right? We had my grandmother actually had uh, you know, basically became a general contractor herself. She took all the courses and all that, had this cottage built in Thornbury back in the 1970s. When both my grandparents had passed, they decided to sell. And this is where we get into some of these complex situations. There were 7 kids. And so how do you make those decisions? Those are really hard, tough conversations with family. This one, they made it easy. They just said, okay, we're going to get rid of it. But the thing is, we haven't had a cottage since like the late 1980s. So I find like we're just, to what we said, what it says on the slide there is like literally chasing cottage memories, trying to find cottages, um, you know, to, to, um, to find family memories.
Yeah, quickly for me, before we get sort of in the meat and potatoes of tonight's webinar, you can see this is my cottage down here on the right, Lake Kashrigmog, North Shore. It's been in the family since it was built in 1934. It still is almost in its exact same conditions. We really enjoy sort of the cottage scene. We really just hope to keep this in the family for my 3 kids and generations to come. So yeah.
So today really I mean, this speaks to overall what we do, but, really for us, our goal is to, preserve the family cottage for future generations. As I mentioned before, we do work with a team of experts, whether or not it's other advisors, teams within the insurance companies, but then also we've had the previous events we've had, we've brought in some of our collaborators. So we've brought on a mortgage broker, we brought on um, lawyer for my in-law, Emma Michael, to talk about really all the different structures to build around this. And then we've also had Jim Woody on to talk about, he's a CPA by trade, and talking about how all the how to really understand what we're working with, and then how to execute upon it.
So the next, next slide we're talking about are what are the problems. So really, there's a reason that everyone's sitting here today, because the cottage landscape has drastically changed over the last 15 years. Cottage real estate has dramatically increased, as of all real estate across Canada, and this is presenting some problems and some threats. So what are the problems? Well, the first thing, family dynamics, and I can definitely talk about family dynamics. But that is, with the growing of families, you're going to have growing pains. You're going to have who is going to use the cottage, who's going to take care of the cottage. Does so and so get along with this person or not? And there, we can't escape family dynamics, but we can certainly start conversations. And that is actually, when it comes to sort of our 3 pillars of cottage succession planning or cottage legacy planning, having family discussions is number 1 and probably the most important one. We have maintenance and upkeep, certainly a problem. Property taxes, cottage mortgages. Mortgages and cottages are very difficult to get. The banks play by different rules when it comes to cottages. Whether it's running water or the septic systems, or whatnot, they getting a mortgage is rather difficult, and that's where the funding piece comes in. And then we have estate taxes and capital gains tax, which have cropped up, and with the increase of costs in cottages, have really spiked the capital gains cost. So, Peter, I think you're going to talk a little bit more in depth about four of them in the next couple of slides.
Yeah. So as we go, yeah, and I don't know, Dan, if you can just watch out for Sebastian as well. I think we've still got this. I've never seen this on Zoom before. We've got 10 of the same people. So I think he said he's on, but we can find a way to
Well,
get.
I think he's saying, Sebastian, here I am in the chat there, Pete.
Does it say his name?
Uh, one of the Jerry Parkers is saying I
One of
am
the
in
Barry
it,
Parkers.
and
So
he's
yeah,
identifying that it's him.
yeah. So if you can, while I go through this, see if I can roll through. So apologize for this. As I said, I've literally been on hundreds
No,
of
I've never
Zoom
ever
calls
seen
before.
this. Yes.
So anything's possible with technology, right? So the good and the bad. But anyways, it's as we go through some of these things. So sorry, I think I skipped a slide there, but we had Jim on when the CPA from Miller Bernstein, he just talked about kind of the transition to capital gains, what we're seeing it. I think as a cottage owner, you're probably pretty aware of that in terms of what your gains are. Um, in general, because what happens, I think, if, not everybody's familiar, but when an asset such as a cottage or any of these real estate, whatever other kind of assets you own, not go from spouse to spouse, but they go generation to generation, you're going to see a capital gains tax. And so that's something we will talk about in terms of how do you manage some of that. But then at the end of the day, it still needs to be tackled, right? Even if you're doing deferrals or trusts and all that, like those are great ways to kind of build some structure around it, but this still needs to be funded. So we're gonna dive a little bit deeper into that piece. Property taxes are an obvious. That's obviously not going any lower. And so go back to the previous point of capital gains tax. I don't know if that's the last. I don't know if any of us believe that that's the last hike that we'll ever see. But we know it's growing too. As long as values of properties are going up, then obviously we're going to see, all taxes go up in general. Maintenance costs, that's, obviously even as a homeowner, I know that my cost to maintain my house is always there. And there's always something happening. The cottage as well. Obviously there's potential, depending on where you are, where you're situated and all that can get impacted more by nature. The other piece too is we didn't even put in here, that's maintenance cost, but what happens if something big happens, right? You got to replace a major item at the cottage, whether it's a roof, a septic tank, anything like that. There's costs that are always going to be there. And then the last piece is, like, if you don't have a mortgage on it, then that's great. But there's we've talked to some of those solutions in terms of like, how do you buy out someone in the family to keep the cottage going. This could be a reality, right? It's getting a cottage mortgage, and they're pretty tough. So we had Jennifer Rositas on last webinar to talk a little bit about that and how to navigate that as well. So you thought getting a mortgage on your house is hard, getting a mortgage on your cottage, if anyone's done it before, is definitely not any easier.
Yeah. So cottage price realities. So really the reality is we can see here from some statistics from Remax Statistics cottage trends. The average Muskoka cottage sale price is 1.4 million. Average Halliburton approaching $1 million there. Kawartha cottages approaching 900,000. And really what this means is, if once there is a deemed disposition or a sale, these capital gains are going to be big. Especially for the people that have purchased them years ago, whether it's 20 or 30 years ago, where they were purchased for $150,000 and now they're worth 1.4 million, there is going to be a large problem. So we're really looking at sort of the solutions that we're going to be building out. And we're just coming up to the good stuff. So next there, Pete. Family dynamics. So you know, who wants the cottage? This is a conversation that we really recommend everybody needs to have. And actually, it's a takeaway from tonight's webinar is to go and start these conversations about the long-term plan for the cottage. So who's willing to maintain it? Who really wants to use it? Who is not entitled, but who is going to, like, how are you going to block or chunk the time for who is going to use the cottage? I know I share the cottage with my sister and my father, and we have a schedule where we have sort of designated weeks, and then we have open weeks. So that conversation, that dialogue is really happening, and it's ongoing, because if you don't have these clear lines of communication, and I'm sure people on this call tonight know the challenges when it comes to family dynamics, um, and that sort of leads us into sort of the long-term solution.
Right. And so that's kind of those are tough conversations for sure. This is the next piece is okay. That's kind of the day to day, I think, really like understanding the dynamics, but those dynamics filter into not just day to day, but then into potentially into the generational problem as well, too. So when it comes down to it, when the patriarch or matriarch passes, who in the family wants it? Who's going to take care of it? Who's going to pay for expenses? The maintenance, all those other pieces that go on with it. Um, so having that conversation as a family is so important. The second piece is building the right structures around it, right? So estate planning, wills, trusts, whatever that may be. We had Emma on, she talked about, I have a slide on it too, but she's got a number of different ways and options in terms of how to build some structure around it. That's really based on that family discussion as the first starting point. And then finally, protect the cottage funding, right? So really, in the end of the day, no matter how you slice it, whatever we do in life, we have a partner in life and they're never going away. And it's the CRA, right? So we know we're going to pay them at some point. So, when we pass this asset down from generation to generation, they're going to want their cut. So, we're going to talk about different options in terms of how do you fund something like that. I guess this is me. So the family meeting is kind of that first step on that three-pronged approach. And really just we had built a document. We can definitely send it. Then if anyone has any questions on it, I'm happy to send that over. Just really to run through. I keep on saying it because I find, like, I don't know, Dan, you tell me though, how often do you have these conversations? Is it something that comes up during the summer, or is it end of the year, or is it getting back to the cottage again? These are things that come up, right? In terms of what you wanted, what the plan is, right? It's kind of something I find like a lot of these conversations we're kind of dancing around, right? So it's really someone's got to take this on and kind of lead that conversation and really get an idea. Because until you have that meeting, nothing else really is moving forward. So really get a good understanding of that, and then at least give yourself some options to what which direction you want to head. The next piece is the legal options. And so there could be a whole array of different options that come out of that, right? So are you transferring the family cottage to the family? Are you selling it to the family or outside? Are you changing the ownership agreement? Is there ways to build the estate plan so that you have that covered within the will? We talked about when we had Emma on about a cottage trust as well, or transferring cottage to a corporation. At the end of the day, a lot of these things, as I said previously, is we're building structures around it so that there's a bit of continuity to it. And the one thing I'll say is that ultimately there's still going to be capital gains taxes that are tied to it. Even if you're deferring out for a number of years, any trust will have to pay out every 21 years. So ultimately, there's always going to be some kind of funding that's going to have to show up. So it's good to have the structures, but also to have that third piece as well, is which where we kind of specialize in, and that's really about building that whole piece of protecting the cottage legacy, right? So um, the funding piece is so important, and the funding can come in a number of different ways. but you see, maybe I'll bring Sebastian on actually for this slide, because this is like really speaks to what he does and how we built this out here. We've got all these different pieces and elements as part of building out this plan, but it's so important to have that team. Sebastian, do you want to have a couple words on that?
And this is great. And this, what just happened here before I got on, speaks to you could have all the greatest plans, but something can go wrong. Something can go wrong, meaning one of the kids might decide, you know what? No, mom and dad, I just want cash. I don't want the cottage, right? And oftentimes we'll see really complex situations and structures within the family. So as Peter and Dan alluded to earlier about having those conversations, then you could decide, okay, what's the mechanics behind it and what's the tools I could use? And I'm going to speak to it from a life insurance point of view, is using life insurance. There's so many things you can do with it, not only for taking care of the capital gains tax. Oftentimes that's what people look at. But, Peter, you or Dan, maybe you talked about the maintenance of the cottage. Maybe you wanted to make sure that there's some funds available so that when the kids take it over, it's not a strain on them. And now they can utilize some of this cash as a reserve fund to take care of the roof, the dock, and it doesn't put a lot of pressure on the owners of the cottage now, the kids, right? The other aspect is, what if we could use life insurance to equalize the situation for the kids? The ones that don't want the cottage, the insurance can form an equalization amount that says, okay, here's the cash for you, and here's the cottage for your sister, and everyone's happy. But I think it really begins, Peter, is that conversation, and then you can figure out what the mechanics are behind it. And I think the last session, like the first one that you guys did, Dan had talked about the fact of this cash that's building up within this planning structure that doesn't get eroded by taxation. It's something that's often overlooked, and it's something that gives you that flexibility.
Yeah, no, so good. And it's a very layered piece. So we're not expecting people to get full clarity out of this. We're creating some conversations for you within your family and start that. And, you said we can definitely help guide some of those pieces together. Some people who are in life insurance for the first time, they're like, what the heck are you talking about? This doesn't make sense at all.
Yeah.
We're going to dive into it a little bit deeper as we go through the presentation, but understand, there are options, but we'll have the conversation here, but it will likely include a follow-up conversation should you want to know more.
All right, so we have some new people that just jumped on. So we want to make this as interactive as possible. What year did your family buy or build the cottage? I think we already had that for most people that are on, but if you just wanted to populate that chat for those that haven't done that already, please go ahead and just sort of let us know when you jumped into the cottage scene, or when it was built, 1970, year 2000. Thanks everyone for doing that. Amazing. Yeah, you can see, it's hard to believe that year 2000 was 24 years ago, which is unbelievable. So, all right, Pete, let's keep this train moving. I'm really excited about this next section.
For sure.
We're building some really strong momentum. So how do we pay for the cottage? Is this me or you, Pete? Sorry, am I jumping your...
Yeah, it
Oh,
doesn't matter. Yeah, I can do it, but you can add to it as you.
Yes, perfect. Go ahead.
Like, I mean, at the end of the day, we went through the three pieces, right? One is to have that family meeting to start that conversation, understand who wants it, what are and then from there figure out options. Next piece is to build some structures around that with your legal team. Obviously you'll have your CPA as well to understand kind of what are the scenarios. And then this is where the funding piece comes in too, because that's important piece. As I said, ultimately CRA is tied to us for life, no matter what, and they're always going to get paid. And what we like to say in our industry is, like I'm happy to pay my tax, but I don't want to pay more than I have to, right? So that's part of what our specialty is making sure that we kind of get a good understanding of that and pay it out as needed. When it comes to the cottage, there's different ways of paying for that gain, but it as as Sebastian alluded to as well, is also potential to fund and use now, not just when that transition happens from generation to generation. One is a savings account. Savings account or sinking fund can be great. Not everybody's great at it because it takes a lot of diligence to build structure around that for sure. Selling stock portfolio, selling real estate, or getting a mortgage on the property. Again, all those things come with you have to weigh between them for sure. If we're selling stocks or selling real estate, what's the market like? If it's cash flowing real estate, do you want to sell the golden goose, right? So there's an opportunity cost with that too. The idea with the life insurance is that it can stand alone, but it also can enhance whatever plan you built out as well. So, but the idea of it is it funds right away. It's cash that's there, and it's money that's been saved up that it's paying for a dollar's problem for a lot less than a dollar. And that's the idea behind putting a contract like that in place.
All right. All right. We need to understand the need to protect our assets. So let me frame something for you. We have our houses, and in order to protect our houses, we get insurance. So we get fire insurance and theft insurance. So we're protecting our assets. We have our car. We have that nice shiny car. We don't want that car damaged without coverage. So we put insurance on that car. So it's so important to have insurance in place to protect also our cottages. So we need to protect this amazing asset, these amazing memories, because cottages are going to continue to go up in value. Capital gains is going to continue to increase. Costs are going to continue to go up. So why not put protection in place on our cottages in the form of sort of a cash value life insurance in order to protect this incredible asset. So I just wanted to sort of frame that so we can get our heads in the right mind as we sort of jump into the meat and potatoes of our webinar here.
And so, the question is why are we using it? We'll get to some examples, and you'll see how this at a high level how the tool works in itself. But it's basically, what I call it is it's kind of like a TFSA in a way, the way that it grows, because it's you put a dollar into this into this contract policy. You're the owner of it. At the end of the day, you control the outcome of it. It's a unilateral contract between you and the insurance company, and they know they have to pay out that benefit at some point. They just don't know when. So the cash that goes in there accumulates tax free till the end of time, or till we see that transition. You're able to use it tax free as you go through your life, and then of course that windfall will go to the family tax free. And so we're using that to extinguish the capital gains tax, which is inevitable. And we're going to talk a little bit about it, but it's so important, and it's so good to start early. The earlier you can start it is great, because then you can start making something generational, truly generational. And we'll give you some examples of that as well.
Yeah, so we're really trying to break down, we have two basic types of life insurance. We have cash value life insurance, and that's what we're talking about tonight. And that's what we're really encouraging people to sort of branch out and look at for their cottages. And then we have term insurance, and just trying to break it down for people, what are the difference between these two? So I really like the house analogy. When we own our house, when we own our house and the house goes up in value, equity is created. So we've created equity. If we rent our house, we are paying rent and we're not creating equity. So with term insurance, we are just renting our insurance for a specific amount of time. So that, but when we have cash value life insurance or permanent life insurance, we are actually putting money into a policy, and it is creating equity. And what Sebastian and Peter were talking about in terms of using life insurance now, we can actually take collateralized loans from our life insurance policy to help pay for maintenance around the cottage, boats, roofs, bunkies, docks that need to be fixed. So it's actually a use now and a use later, and that's why it's so effective when it comes to legacy planning for the cottage.
Yeah, and I mean, just to add to what you said there too, like we know, and service clients that do have term insurance as well. So this is not to say don't get term insurance, but it's talking about what is the purpose, what are you trying to build out, and each in itself will serve a purpose.
I think Sebastian wanted to say something.
Yeah, I
real
wanted to
quick.
say
Yeah.
something before my daughter jumped in there.
Oh, yeah.
There's sorry. There's one thing I wanted to add about the cash value component of it, because it's hard for people to understand some of what we're talking about. So one of the things I wanted to kind of really ratchet in is the fact that, Dan, you talked about taking a third-party loan or a loan against this policy, collateralizing it, meaning you're using this asset to secure a loan on favorable terms. The wonderful thing about cash value life insurance is the cash within that policy continues to grow. And so you've got an asset that's growing, even though you're taking a loan against it. And it's something that's pretty interesting in using insurance in this space. And we see a lot of clients doing it in this way. So I just wanted to bring up that. Maybe next time we'll have an actual case and we can show how that looks.
Yeah, and to your point too, I mean, compared to other assets, real estate or stock portfolios, whatever it is, those assets will go up over time. The difference is that life insurance goes up guaranteed every single day. Every single day. It's a guaranteed contract. And that's a big piece why we like to have that as part of the portfolio. Because no matter what's happening out in the outside world, market, health, whatever is happening in life, it's something we know that we can count on. And that's kind of why we like to talk to folks about just understand a little bit more where this potentially could fit and what they're planning out.
And also it's non-correlated to the markets, right?
Right.
So you've got an asset that's completely separate from what you're doing elsewhere.
It's a contract that you're going into with the life insurance company. They have to live up to the obligations. Your only responsibility is put in the payments for as long as you choose to, based on the contract. But yeah, you're right. Dan, over to you.
Yeah, so the process. So how do we do this? How do we implement this? Keep the cottage, fund the future. Step one, policy on a cottage owner, and ideally the future cottage owner. So generation 2, generation 3, owner, kids, grandchildren. And we're going to talk more about sort of the children, grandchildren in the slides to come, and how valuable that these policies can be when they're started at a young age. Number 2, we pay our premiums yearly. Okay. We can pay them monthly. There are a lot of different options, but the second step is funding. Third thing, the policy.
I was going to add to it. You don't have to pay forever either, right? That's the other thing too. But yeah,
there's so many different options we can build in. Yeah. We can build in depending on the need of the individual or the goals that they have. The great thing, step 3, is the policy grows on its own each and every year. So like we were talking about before, it's not tied to the markets. It just does its thing. And then finally, death is going to happen. It's inevitable for us all. Once death occurs, tax-free death benefit is paid out to offset capital gains, property taxes, future maintenance costs. The influx of money comes. All right. So that is the 4-step process. Pete, next slide. I really love this slide. So fund the future, protect the cottage. You can see here how we have from generation to generation. So we have cottage owner, Gen 1, cash value life insurance policy is in place. A death occurs, money passed down to Gen 2. Their cash builds up in Gen 2. Death eventually will occur with Gen 2 as well, passed down to Gen 3, and we've created this legacy. We've created this fund. The cottage will be secure because we have these funds flowing from one generation to the next. All right, case study time.
Sorry, can I just add one thing, Dan?
Yeah.
So one of the things that's very specific to insurance in itself is, with this setup, there's also the ability for, let's say, a grandparent to transfer the policy without affecting any taxation. So that's one thing to keep in mind as well.
Yeah, and we actually have some brief illustrations coming. Sebastian, I think it's going to give the the people a really good visual on how this can be so effective. So
Sebastian, you're can you expand upon that comment? Is that a grandparent owning a policy on someone else? Is that what
Yeah,
you're
that's what I was thinking. Like sometimes someone might say, "Oh, you know what? I'm in my 70s. I've got a lot of health issues. How in the world can we do this? And I've got some cash sitting aside for this." Well, we could set it up with generation 2 or generation 3, and generation 1 funds the policy and then transfers the ownership to that second or third generation. No tax consequence. It's built into the Income Tax Act.
perfect? Yeah, no, that fits perfectly into what we're going to talk about, right, Dan? So that's good.
no, nailed it. Absolutely. We think it's really important to have case studies. We want to visualize ourselves in this scenario and how this can work. So we've created this case study, and maybe you can just really try and maybe see yourself within this. So here we go. John and Sarah purchased a family cottage in 1995 for $250,000. Today, the cottage is worth $900,000, and they want to ensure it remains in the family for future generations. However, they are concerned about the potential capital gain tax their children will face when they inherit the property. Projecting forward 25 years with an average annual growth of 4%, the cottage could be worth $2.4 million. The capital gain would be $2,149,000. In Canada, the capital gains tax is applied. In Canada, capital gains is applied to 66% above the first 250,000, and that came into effect back in June. In this case, 1.8 million would be subject to 66% of the new inclusion rate, resulting in a taxable amount of 1.2 million. Combined with the first 250 taxed at 50% inclusion rate, the total taxable gain would be $1.378 million. At a 25% marginal tax rate, because it goes on to your earned income, John and Sarah's children would face a tax bill of approximately close to $350,000. So, to avoid liquidating assets or taking on debt to cover the tax, John and Sarah used a cash value life insurance policy. By investing in a policy or setting up a policy with a growing death benefit, they ensure that upon their passing, the policy proceeds would help cover the capital gains tax. This strategy helps their children keep the cottage in the family without financial stress. Additionally, John and Sarah recognize the importance of securing the financial future of their children and grandchildren. By purchasing a life insurance policy for them, they not only lock in the low premiums early, but also create a legacy of financial security. These policies can accumulate cash value over time, providing their descendants with the liquidity in the future to cover expenses like maintenances, taxes, and unexpected life events. This multi-generational approach ensures that cottage owners remain financially protected, keeping their family cottage within the family for generations to come. So, very, very powerful. I just wanted to kind of pause here. And does anyone maybe have any questions about this or how this was set up? Or, I really like the fact how, just providing this structure and having the foresight and thinking can be very, very powerful.
To me, what I take from that is just really is we started with the three-pronged approach, right? The family meeting, the building the structures based on that, and then the funding piece. And once you see those numbers, like I know what my number is now, but what is it projected to be too? It's so important to know your numbers and make sure that if you're not doing yourself, to involve your professionals to help maybe calculate that and project that over time in terms of what that will be. We talk about the cottage being in a way, like for many families, it's priceless, right? And so, but unfortunately, priceless comes at a cost. So, understanding that number is really important.
So we had a question come in here, and maybe Peter or Sebastian can jump in. So an individual in their 60s, is it too late for them for life insurance?
Sebastian, you want to take that one?
Absolutely not. Of course, there's a little bit behind it. So health is the only thing that matters when it comes to being able to get life insurance coverage. But we insure people in their 80s for life insurance. So it's all about your health. And sometimes, there's things that are going on. But if you're seeing the doctor regularly, if you have issues, you're taking your medication, it's pretty good that you're going to get a policy, and there's not going to be an issue. And of course, family history does play a part. So that's why we see, what Peter was talking about earlier, is we see grandparents setting up these plans for their grandkids because they're young. There's usually never any issues. So if for whatever reason a grandparent or somebody older, and let's say 65 plus, cannot be insured because of health, then there's other strategies that you can employ. And again, it's all in the way that you're planning. So like I say, is start the planning, have those conversations, and see if it makes sense for you, because there's each person is completely different from the next. So everyone, you can't say, okay, here's the solution for everyone. No, I've never seen it in the 25 years I've been in this business. Never seen that.
No.
Yeah, and Subhastin, thank you. That was a great response. I one word I really like, or one sentence I really like, is the insurance companies are not looking for the perfect human being. No human being is perfect. Everyone's going to come with their differences, their nuances. You just have to you have to go and see what is available. So I wouldn't hesitate to at least try or start. So
Yeah.
Yeah, Megan, you had a question. So if the cottage is your primary residence, yeah, the likely, so in as a general rule, the primary residence you're not going to see the capital gains transfer, correct? But just make sure you have that checked with your CPA as well, because there's time where maybe you had owned it as a second residence and then moved in. There might be some kind of calculation that has to take place before. As you said, CRA knows more than you'll ever think they know. So just make sure you involve a professional and make sure that, it may not be a full burden cost of the capital gains, but maybe it's based on, when you actually moved into that as your primary residence, if it wasn't originally your primary residence.
And just to second that is, Peter and myself, we have great contacts when it comes to all the industry professionals, of course, Subhastin as well. But if you're looking for a referral for these professionals, we can definitely send you in the right direction to people we trust and that we work with on a regular basis. So yeah, thank you. Oh, another question: is cash value similar to or rebrand of whole life insurance? Yes, that is correct. So whole life, permanent, cash value life insurance. There are different products, but that is what we are talking about here tonight.
Yeah, we didn't want to get too deep into very product specific. We just want to talk really high level concepts. But yeah, typically we're working with par whole life contracts is where we go, and we do have reasons why we do it. Mostly it's because it's guaranteed, right? You're putting the onus on the insurance company to grow it, and it's not subject to any other outside forces, additional costs. Your costs are sure throughout the life of the contract, and the growth is going to be you're going to see volatility of less than 1% over 10 years. It's very smoothed out. And the other great thing about it is you don't have to count for taxes. A lot of these things where building wealth is like, okay, example cottage, right? Is we still got to figure out what our taxes are, because what we think we own is not what we have, because Sierra is going to take their cut at the end of the day as well. The next,
sorry, Pete, go
yeah.
go ahead.
No,
No, I was just saying I'm really excited about I'm really excited about this. A lot of people have some questions, and this is sort of some basic illustrations on how how it works. So Peter, I think this is yours to take away.
Yeah, so absolutely. So this is a use case we're talking about, the cottage owner using, in this case, using the life insurance to pay out capital gains upon their passing from one generation to the next. But also, I added in there too is like use account while living because that's accessible to you at any point in time. So this is someone who's the example. I'm not sure who asked that question, but can you start it? So this is an example of a 6-year-old starting policy, $5,000 a year over 25 years. So putting in is that 250K? Is
Yeah,
it?
that would have so we designed this policy for the case study that we did. So in order to extinguish the capital gains and have a little extra for maintenance cost in future, we actually set that up for this. So it's a death benefit of 250,000 at age 85.
Right. Okay. So that's
Yeah.
the play out on it. But you'll see over time that um, there's two components, right? The dividends are going to continue to grow, and that may be a component that helps pay for your policy down the road. If you're not going to pay. Maybe you choose to pay 10 years. A lot of times, we'll just show an example of here's it is for 10 years paying into a policy, even though you have the opportunity to pay as long as you wish to. But in this case, so you'll see after 5 years, the cash value has grown at about what you've put in, but there's between that and a savings account is you've actually got a death benefit that will pay out. So that will continue. Each of those components will continue to grow throughout your time. So over 15 years. Sorry, I've got to I'm gonna pull my calculator because I'm not good at math while on the fly here. So 75 years divided by
You
so
know, just what piece doing the calculation there. We have the total cash value is your equity that you're building in the policy. So Sebastian was talking about using it while we're living. We can borrow up to 90% of our cash value at any given time. So that's what's so great is if something happens around the cottage, you need cash quickly. You can take a collateralized loan, access that cash, pay off what needs to be done at the cottage, and then with new money that's coming into the system, you can service that loan.
yeah. So just an example at age 75, you've put in 5 times 15, so that would be $75,000. The cash value is grown to 96. If something happens, then the payout is actually 152 in total. So while you're living, you can use this. Whatever you haven't used will this will pay out minus whatever you've used on that system. And then we go into the next generation. So this is an example of 15 years at 5K for next generation starting at age 35. To go through, this is as we dial this back a bit, you can see there's some other components where it can be used. So it could be used to supplement retirement at age 65, right? So you put in 75K in total into this, so 5 times 15. So over the course of time, you can see that it's growing in multiples of what you put in. So in total, so you put in 75K and you're 30 years into it, and it's grown to 326. Could be a great supplement to retirement, and so on and so forth as you go through. But this is really at the end of the day, we said we built this in this case is to extinguish any capital gains tax on this, but potentially can be used through other parts of your life moments or life transitions.
Peter, there's just a quick circling back. There's a question in the chat that I think is fantastic. The question is there two owners? If there's two owners on the cottage, does each owner require a separate policy? So would you, I guess.
So the big point is where the capital gains tax kicks in is generational transfer. So if one spouse passes, it goes to the other spouse. You're not going to see a capital gains tax if one goes to the next. So typically we would see there are options to have two different policies. That's typically how we see it. You can have a joint last to die so that when the second person passes, then the capital gains is taken care of. Just depends on the scenario really in terms of what you want to do. Maybe that person, the second person who's still living will want to take advantage of, not necessarily just for the capital gains piece, but maybe it's for living expenses for them while they continue on. So that's why we potentially would have a separate, but we do have cases where people do them together as well. This is the last one. We call it like a gift to the grandchild, right? So this is putting it in 2K a year for 20 years into a grandchild's system. You can see how this can grow pretty immensely over time. And literally by retirement age, they're going to see $1 million. I've done these scenarios. I've done one. I think I did one before where we did like 10K a year for 20 years, and it's like $4 million. It's crazy how these things grow. And they are literally, it's a unilateral contract. They have to guarantee the payout of this. As soon as that, every year that death benefit goes up, that cash has to grow faster. So it keeps on just compounding, growing and growing.
Awesome. So we talk about, how did that policy go from $2,000 a year to over $1 million? And the real reason is uninterrupted compounding interest. So I really like what Subhastin said earlier on, where you can take a collateralized loan from your policy, but the policy continues to grow uninterrupted. So in this slide right here, we can see the power of uninterrupted. Okay, compounding on your money. Now, the next slide is very, very powerful. When we interrupt that compounding, whether, if you had another savings vehicle where you were saving, and then pulled out to buy a vehicle, and then saving, pulled out to buy or fund a wedding, it's going to interrupt that compounding, and it's not going to allow that money to really, really, really grow and compound over time. And that's what's so advantageous about these life insurance contracts, is the ability to compound your money, but also use it, but then have the security of the death benefit to take care of cottage expenses long term. Yes, perfect. Meg, sorry, if you jump off the webinar, we're going to send everybody here a recording of tonight's webinar if you have to jump off. So yes, we will send that out to all attendees. Another quick question here. If you borrow 90% of your cash value and you die, is the total benefit payout still the same? So whatever loan that you have out with the insurance company will get extinguished by the death benefit. So if you do have an outstanding loan, they will extinguish the loan, and then they will pay out the remaining.
And you're not going to be in a position where it's going to be more than what the death benefit is. The cash value will never equal the death benefit until age 100. So it continues to grow throughout life. So you may have a death benefit of $1 million, but you borrowed $400,000. So the $400,000 will be extinguished. Your family will get $600,000. Tax-free windfall to them. Hopefully it's obviously not just I go back to, I think I mentioned lottery before. Hopefully it's not just like a lottery ticket where they get cash, but you have a bit of parameters around it. But yeah, it pays out tax-free.
Lots of good stuff happening. We have about 10 to 12 more minutes, and then we'll do questions, but just want to sort of give that context. I love this chart. A penny a day that doubles every day for 30 days. So if you take 1 penny, you double it every day, double. At the end of 31 days, you have over $10 million. The power of compounding uninterrupted interest on your money. And then, of course, if we pay for a wedding, or we pay for a new car or a new boat, or we have to pay for something, and we interrupt that compounding, you can see the difference that it makes. On day 31, it's only $2.6 million. So it's a massive, massive, massive difference. And that's why we need to let our money compound. All right. Peter, is this me or you, this one here?
It's you for this one, yeah.
Okay. The advantage of, we've talked about this. You can access your cash during your living years. Okay. So let's just type in the chat really, really quick. What are some major expenses that we know of for cottages? So is it a roof? I'm betting someone's going to put septic system in here. Docks. The price of docks is unbelievable. Someone's got to put boats in the chat. Please, someone put boats in the chat, because, break out another 1,000 is the acronym for boats. I'm not sure if anyone's filled up their boat lately, but it's like every time you go, it's $150 or $200. Decks, that's another one. So docks, these are things that age. Decks, these are things that age. These need to be replaced, and they are not cheap. We can access our money inside the life insurance policy to pay for these maintenance costs. So it's almost like a forced savings account over time. And when you need it to pay for ATVs, when you need it to pay to replace or repair these things, we can access that money with a click of a button. And what's great about this is you don't need to be approved for this money. This isn't an approval where you go to a bank and say, "Hey, can I get a line of credit?" The insurance company has already approved you because you've made a contract with them where they have to pay out the death benefit. So they're contractually obligated to pay this money. So you can access the equity inside the policy because they already have collateral in your policy. Subhastin, did you just want to sort of just elaborate on that just a little bit there? I think it's right up your alley when it comes to sort of accessing the money and paying for expenses.
Yeah, so it's a great point there. So you always have the ability to go and take a policy loan from any company that you're dealing with. It's a contractual right as a policy owner. Number two, why would you want to do that? Well, is we talked about the fact that the policy continues to grow and unabated, even though you're taking a loan against it. And then if you die, they're going to subtract the loan and give you the death benefit. But there's also another factor in there is once you take a loan from the policy and the policy is growing and you're paying back your interest, that interest, like in a mutual, it actually is like indirectly coming back to you. So the difference between the two is very, very small. So it actually helps you, and you could pay back the loan and restart it again. So is that what you were thinking of, Dan? Is how the mechanics work?
Yeah, just the ability, and a really good question. A really good question just came up, Subhastin, that pertains to what you're just speaking about. Is if I take a loan, does it affect the compounding of the policy?
No, it doesn't. And that's the thing is the loan is not actually coming out of your policy. It's coming from our general account. So we're providing a loan to you. And some people, they find themselves very highly leveraged outside. So if they were to go to a traditional bank or credit union and try to seek out a loan, they may not qualify. The thing about a life insurance contract is when you request a loan, it's against your policy. There is nothing that's checked. We don't look at your credit score. We don't look at how leveraged you are. It's a right that you have up to, as Dan said, up to 90% of the cash values. So it can help you in such a multitude of a way. But it always comes back to the fact that I always say is speak to your advisor, speak to Peter, speak to Dan, because each one of you are so different. And there's so many things that you can do and structures. It's just like we'd spend days talking about how to structure these things.
Yeah, it's so good. And after all that, we said you do have the right as a policy owner to be able to borrow from it, but you also people know banks love these contracts too. They will collateralize them all day long too, because they know it's a guarantee for them. They guarantee the cash value at 100%. So it is possible doing through a bank. The easiest way is probably directly through insurance company though. Just depends on your situation, right?
Yeah, for sure.
I gotta go kind of briefly through this. We kind of covered off a lot of these things. I got a couple stories that will really talk about this too. So the contractual growth, tax-free growth, liquid. I mean, that's a big thing with people with assets is like where do you get the cash? This is something that's very liquid. If you need a loan for less than $50,000, they're going to send it to you digitally, literally like a internet bank transfer within a few business days to you. If it's over that, then they might have to send out a check. But again, it's your right. Protection in case of life circumstances. I'm going to go through a story that'll talk through that. So I'm going to leave that. Flexibility is really based on how you use it. Safety is that it's a contract that the life insurance has to live up to. So it's going to grow every single day. They're reducing the risk because they have to pay that bill eventually. And by doing that, they're growing it every day. Subhastin just talked about like nosy credit checks, all those kind of things. This is something that it's a private contract between you and the insurance company. Yeah, so I'm going to move on to the next slide here. This is where kind of dives into that previous slide, like couple of things. So one is when I talked about private contract here, business owner. So these two guys are retired. The one business owner, I should just change it over to this because he had literally had $50 million in real estate. And this sounds like a crazy big number. He had no mortgages on it. It was fully paid for. He was retired, but he wanted to go deeper and further to double his business and grow his real estate empire. Unfortunately, because of a few deals, he got a couple bad figures involved. The market turned a bit. He lost it all, literally lost it all. It's crazy just in the last few years. But the one thing he had is he had a private contract called life insurance, and the life insurance has $4 million sitting in it with an $8 million death benefit. So it's a contract that he got 40 years before when him and his partner had started the business, and it's there. The creditors can't, they're trying to get off him, but they can't touch this contract. He's protected, which is amazing. I have a friend who told me his story. He said, we had massive capital gains on our cottage. And he said, until we get life insurance, like we had to consider selling our house. And they were considering it because they probably felt more, there was more memories tied to the cottage than it was to the house they built. The last one is really about, understanding like, so we look at, I give you the example of the Rockefellers and the Vanderbilts, two famous, world famous families that have built the Rockefellers have built 6 generations of wealth over and over, and they have a really tight process and have thought from the G1, G2, G3, how to pass that down, building out with proper estate plans, wills, trusts, and also life insurance as part of that process. The Vanderbilts, I believe, had more than the Rockefellers at some point. They had $200 million 100 years ago, more than the U.S. Treasury at that point in time. And within 2 generations, they had spent it all. There was not one millionaire left. There are a couple of Vanderbilts you may have heard of, but someone like Anderson Cooper is more self-made than actually living off his um, family well. So, when I say that, like the Sierras partner with us, there's so many things where we're building up to build up that roof or that ceiling higher. What we do is about building up that foundation and making sure that we're sealing in all that you've worked hard for, right? At the end of the day. And taxes, taxes are inevitable. A lot of the approaches, as I said, you will have wills and trusts and all that too, that you may see, state freezes and all that too. Inevitably, there's always it's gonna have to time out. A trust in Canada only lasts 21 years. You still have to pay tax at the end of the 21 years. The one thing that's not gonna trigger a tax at the end of the 21 years is life insurance that's sitting inside that trust, if that's where it potentially is. So keep the cottage, fund the future. Really, for us is we're kind of the rubber hits the road for us is really have that plan early, plan long term, have that vision. We know that people have created so many memories around this, and we want them to be able to sustain or build what they envision. And for us, we believe it truly aligns to whatever families are looking to achieve. I think that there's definitely different ways of doing it. But like when it comes down to it, it's something, a long-term vision, but it's also something that we can help with now as well.
Peter, I was just thinking about something to Jerry's question about having two separate life insurance policies. I think it's probably advisable to have two separate, because what if you wanted to do something and you set it up together like a joint policy, and you're limited because maybe your brother doesn't agree with, hey, let's spend money on the roof or the dock. Maybe it could last. It gives you that flexibility to make those calls.
For sure. It's a rare occasion for sure to do the joint.
Yeah.
It's very specific. That's why I didn't say we never do it, but yeah, it's a majority are definitely separate policies. I agree with you on that. But again, it really just depends on your situation and what you're trying to achieve. And sometimes people are trying to really box in certain situations. So there's a lot of moving parts for sure. So I agree with you on that. Absolutely. Our process. So for us, really about us, I've actually got a QR code right here, which you can reach out to. Let me just make sure I got the full QR code, because I think I've got a video in the way here. is reach out to us, set up some time just for an intro call, right? There's no obligation to it. Just to understand where you're at. Maybe that just helps you kind of, we're hoping out of this, it prompts conversation for you, for your family, and takes you to the next step. He said, we may be further down the road in terms of what is needed as part of the plan, but we do have a great team of collaborators, professionals that we work with that we can definitely suggest as needed, whether it's a CPA, a lawyer, someone to deal with mortgages, whatever that is. This is what we do. We build teams to build out great solutions for clients.
Quick question in the chat there. How soon can you access 90% of your cash value? Is it after a set number of years? Sebastian, did you want to?
That's a great question. And
fantastic.
yeah, and you know, again, it goes back to how you want to plan it out, because these guys can create a plan where you can have that instantly, right? Or you could have it deferred to 5 years or 10 years. So it all depends on what you're trying to achieve. And again, it talks to the flexibility of the construction of the plan.
Yeah, and I that's a great point. And to me, it depends on who you are, right? And right, depends on the plan. A lot of people I deal with though like to be closer to their money, so they want to have access to money right away.
Yeah.
Literally, once that policy is settled, once it's up and running, you can borrow from it right away. It's a percentage of, like, it's 90% of the cash value at that time, so it's not going to be fully what you put in, but it's the value of the cash value at that time. And we walk you through in terms of what that looks like, the projection of right now, and typically the end of year value, so that we can kind of plan accordingly to that. But yeah, you're right. There's definitely lots of options out there.
And Equitable has done a fantastic job making things very, very user friendly. So these, the life insurance, sort of your policy is linked up to a portal, and it's much like a bank portal where you can see values, you can see all the information, and you can actually take collateralized loans with a click of a button, and the money is e-transferred or mailed to you, and however you want it. But it's very, very user friendly, very transparent, and all up front.
And that's the point. Great point, Dan, too, because when you look at an account like Equitable, you can literally see day to day. You can see the cash values growing up from one day to the next. That's how easy it is. But that's that'd be part of something we could show people as they move through that process. And I think that's a wrap. Thank you to Sebastian for joining us and adding some great industry value and experience to this. Dan,
Thanks for having me, guys.
Yeah, for sure. Any closing notes you want to add to it before Dan and I wrap it up?
Plan. And something, I'm just thinking back to someone who said, if you're 60, can you still get the coverage? And I'm thinking about it, you know what? Even if your health was really bad, you need to talk about it and figure out what it looks like, how we can package it, so the insurance company looks at it and says, you know what, yeah, this is a good risk. We're willing to take it. So it's all about planning and starting those conversations. Pete and I, we talk all the time about this, starting the planning, because if you don't, then you know what, you're leaving it to the wind, and whatever happens, right? But you want to be in control of your own destiny. You want to be in control of your family cottage, not let the government dictate for you that they want all of the taxes plus a tip.